What is DeFi? The Beginner's Guide to Decentralized Finance. You have undoubtedly heard the word DeFi used to denote a range of new protocols and assets if you are deeply immersed in the world of cryptocurrencies. It's crucial to note that DeFi is a more recent phrase that is only now becoming more popular. DeFi, the abbreviation for Decentralized Finance, therefore, lacks a precise definition. Instead, it is seeking to explain the goals that a particular class of cryptocurrencies are now pursuing. The majority of DeFi projects are software protocols that leverage a mix of that protocol's crypto asset, as well as their own and maybe others, as a means to automate a financial function. Typically, these applications run on top of Ethereum or Cosmos. The cryptocurrency DAI is a fantastic illustration of this in action. Simply put, DAI enables users to lock Bitcoin in an Ethereum blockchain smart contract, where the funds are then utilized as collateral to create new assets that power its lending business. What is referred to as a governance token, a crypto asset that may enable users to influence project development or generate income from the service, can also be incorporated into DeFi initiatives like DAI. DeFi cryptocurrency proponents contend that this qualifies them as capital assets, comparable to stocks and bonds. Therefore, these new crypto assets attempt to provide exposure to the value of the service supplied, whereas Bitcoin may act as pure money or a store of value. The purpose of DeFi protocols. It is helpful to comprehend the various categories of problems that these efforts are seeking to answer as DeFi technologies proliferate. This section's classification of popular projects into distinct groups may be useful for creating and diversifying your cryptocurrency portfolio. Borrowing and lending. DeFi cryptocurrencies with a lending focus would enable users to apply for a loan using software, doing away with the necessity for a reliable third party. These initiatives could automate the maintenance margins and interest rates necessary for lending, powered by code rather than paper contracts. This permits, among other things, automatic liquidation should balances drop below the required collateral ratio. Even while each loan protocol has unique quirks, they all function similarly. For instance, users can be divided into two categories: those who lend their tokens to the network and give it liquidity, and those who borrow it. To lend cryptocurrency, one would send those tokens to a protocol-controlled address and get interest based on the amount lent. On the other hand, borrowers provide cryptocurrency as collateral. Then, they are permitted to borrow cryptocurrencies up to a predetermined percentage of the value. If the protocols function as designed, users will be able to quickly borrow coins, and owners will be able to profit from their holdings. Aave, Compound, and Yearn are a few examples of lending protocols. Decentralized exchanges, DEXs, may enable peer-to-peer trading of cryptocurrencies by enabling users to swap crypto assets without the need for a middleman. Users of the protocol can frequently instantaneously convert coins without having to open an order book. The conversion rate may instead be incorporated into the network. The theory behind DEXs is that they can give users access to trade pairs even when the volume of the underlying asset is too low for larger exchanges. The fact that user funds are not kept by centralized parties is another significant advantage of a DEX. Instead, they are kept in individual wallets, which increases the anonymity of DEX users. Decentralized exchanges include Uniswap, 0x, and Kyber Network, as examples. Derivatives. The exchange of contracts in derivatives markets is based on the anticipated future value of an asset. These assets could be anything from cryptocurrency to the results of hypothetical future events to actual stocks and bonds. Users can exchange real-world assets like stocks, currencies, and precious metals in the form of tokens on Ethereum through protocols like Synthetic. On other protocols, like Augur or Gnosis, users place bets on how things will turn out. Users of Augur are able to generate and trade shares that represent a fraction of the value of events like sports or political results. Last but not least, protocols like DYDX enable users to exchange margin tokens, giving investors opportunity to leverage short or long bets across a variety of marketplaces. How does DeFi work? DeFi protocols, as previously mentioned, provide a service using a combination of crypto assets. Thus, supporters contend that these services may be superior to those provided by banks and other centralized financial institutions. These kinds of services include automated. Users could be able to access DeFi services around the clock and without having to go through the drawn-out approval procedures imposed by conventional financial institutions. Open. Customers may have a say in decisions that affect the service. This may, for instance, include the option to vote on rate increases. Permissionless. Users may fork a project if necessary or desirable, and they cannot be arbitrarily denied access to DeFi services owing to unfair regulation. Trustless. Users may not need to rely on a central organization to access the service. Instead, they may only need to trust that the software will function as the code specifies.